Good morning, everyone. We welcome you to the third episode of Giraffe Connect. Today, our topic of discussion is understanding debt markets and the home credit opportunity which Giraffe platform is bringing in. Today, we have Mr. Rohit Murarka as part of our panelist. Mr. Rohit has spent his entire life in the world of banking and finance and specializes in the credit markets and capital market ecosystem. He started his career with CRISIL, then was part of Birla Sun Life AMC, where he was a very successful fund manager. Then he joined Kotak Bank in 2014 and has worn various hats within the Kotak banking ecosystem. Right now, he is part of a founding member of the fintech platform which Kotak is building in-house. We have Mr. Vikas Bansal. He is my colleague in Giraffe and he heads origination for us. Vikas is also a 15-year banking veteran. His earlier stint was with Kotak Bank, where he was heading the banking and institutional corporate banking for Kotak in North India. He has deployed over $1 billion of lending products to various clients in his prior stint. He's a pass out from IIM Lucknow and IIT Kharagpur. So today's discussion, we have structured it into four buckets. I, Vineet Agrawal, I'm the co-founder of Giraffe. I'll be presenting initially about what Giraffe is, what we do at Giraffe. Then we move on to Mr. Rohit Murarka, who will help us understand the debt market ecosystem in India better. Then we move to Vikas, who will explain us the home credit deal. And then we open the floor for Q&A session. I request all the attendees to type in their Q&As in the Q&A tab box as and when they have. We will take up those questions in the later half of our journey. One important disclaimer that we want to bring out here is Mr. Rohit Murarka is representing Kotak, but his views on the entire ecosystem are his personal, and he's not endorsing our deal home credit on the platform. He is merely in his capacity as an expert in the debt capital market space. So I'll just start with the presentation for Giraffe. Is my screen visible, Vikas?
Yeah,
Yeah,
but
it is. Yes.
you can make it a full screen.
Yeah. Okay. So Giraffe is a platform for high yield alternate investment opportunity. This was started by my co-founder Saurav Ghosh and me last year. Saurav is an alumni from IIM Ahmedabad and BITS Pilani Goa campus. He started his career in corporate finance domain, and over a decade he has spearheaded the corporate finance team for various developers across India in Mumbai, Bangalore, and Chennai. He has managed transactions over $1.5 billion across the entire spectrum of products, be it structured debt, equity, land purchase, etc. Quick background about myself. I did my engineering from RV College in Bangalore, then did my MBA from XIMB, Bhubaneswar. Started my career in the corporate banking space with large corporate team of Axis Bank. Then moved to Piramal Fund, which was a PE/NBFC kind of a setup. Worked there for almost 8 years. This is where Saurav and we met each other. We did a lot of deals together, and our friendship grew over the years, and we started this platform last year. We have Prateek Goyal, who heads our strategy. He is also IIM Ahmedabad pass out and engineering from NIT Surathkal. He started his career working in the PE space with RBS in Hong Kong, and then was part of the Bravia Capital in Mumbai, which is a private equity firm. For last 5 to 6 years, he was part of a VC fund wherein he managed over 15 investments in the startup ecosystem. My colleague Vikas, who is part of the panel today, heads our origination for Giraffe. I have already given his background to you guys. We are being advised by a couple of good advisors and angels in our journey. We have Mr. Naveen Dhanuka. He was my boss in Piramal, and he advises us. He has an experience of over 18 years across various capital stack products, and he advises us on our day-to-day deals, structures, etc. We also have marquee angels as part of our investors. We have like Siddharth Saha, who is the founder of Farm Easy, Ramakant from LiveSpace, Prashant from MedLife, and other founders as well. They advise us as to how we need to grow the company, the processes that we need to follow. Going to the alternate investment space in India, typically India is a saving market ecosystem. People tend to invest in FDs, in saving bonds, and then once they start earning, they start investing in equities, mutual funds, and once they grow in terms of their income, they buy a house for themselves, invest in gold, or invest in real estate. Apart from these asset classes, most of the people, they don't have any avenues for investment in India, but there are a lot of investment avenues which are typically reserved for HNIs or ultra HNIs or financial institutions, but were never available to normal retail public. Now, if you see the graph on the left, we have these FDs and savings, which are like 5 to 7% yield, or we have crypto and angel investing, which are 30% IRR plus. Between these, there are a lot of gaps in terms of returns, wherein the products are not available for individual investors. We will go into the products later in the later part of our presentation, but this is the gap which basically Giraffe is trying to bridge, wherein we have short tenor invoice discounting products, we have structured credit products, and we have venture debt products. Typically, global studies have shown that people or individual need to allocate at least 10 to 20% of their portfolio in these alternate asset classes. These percentages are higher for institutions, are higher for HNIs. They tend to invest 40 to 50% of their portfolio in these assets. But for retail, because of the difference in the knowledge, it is recommended that they invest between 10 to 20% of their portfolio. I'll just move on. So now the natural question comes is that what is that Giraffe brings to the table? So basically, Giraffe is a online tech platform where the entire process is tech driven, is transparent in nature. We have a credible team we are a team of approximately 30 odd people. Most of us are from previous banking domain or finance domain. We understand the product really well. What we bring to the table is we bring a transparent platform where entire information is available on the click of a button. We have a team who handholds these investors to understand the product better. We have a strong credit risk assessment process wherein we assess each deal before it is being listed onto our platform. So this is what Giraffe basically brings to the table. We provide accessibility, we provide information, and we provide a simple mechanism for people to come and participate in these investment opportunities. A quick background, this is what our platform looks like, where Giraffe is at the center. We are a tech-driven platform. On one side, we have investors, we have our partners and institutions who need to access money, who invest in the deals. And on the other side, we have borrowers, wherein they get an easy access to the capital through our platform. Coming to the products, we have now listed 5 different types of products. These are across yield. As you can see, we have NCDs of NBFCs. These are typically lower yield in nature, between 8 to 12%, 8 to 14% in nature, but tenor of 12 to 30 months. On the other hand, we have invoice discounting, which is a 1 to 6 month product with a 10 to 15% kind of in range. On the higher yield spectrum, we have leasing and venture debt, where typically, yield goes beyond 15%, and in case of venture debt, it goes beyond 18%. So for any investor, the idea is that, they can plan their portfolio in a manner where they can invest a portion across various products and across various tenors. It helps them in their various financial planning, in achieving a couple of life goals as well. What we are trying to do is to bring down the minimum ticket size of investment across the product so that larger people can participate and all these products are accessible to each and everyone. Right now, for 3 of the products listed on our platform, we have brought down the minimum ticket size to 1 lakh per investor. There are a couple of products where the investment size we have kept consciously at a higher number, which is around 5 lakh, given the riskiness of the product. But our endeavor is to slowly bring it down as much as we can. What is our track record till date? We are 8 months into operations. We have done transactions over 125 crore as we speak. We have refunded already 20 crores of capital to the investors who have participated from our platform. We have over 32 members across various teams. We have around 2,700 registered investors, and we have 12 partners onboarded. We have just started our journey, and we aim to create a world-class platform where each and everyone can access the alternate investment opportunities available in India. We partner with some of the best marquee names in the industry to ensure that the entire system, processes, documentation is followed. We have like the Cyril Amarchand and J Sagar Associates, our legal partner. We have Ernst & Young as our corporate structuring, and we work with ICICI Bank to provide us banking solutions. Now over to you, Vikas. We will go to Rohit before Vikas, and we will try and understand the debt capital market ecosystem in India. We have structured this as more of a Q&A kind of a session, and through that we will try and understand the ecosystem. However, Rohit, if I miss anything and you want to tell anything over and above, you are free to do so.
Sure.
So why don't we just start with the basic as to understand what is the bond market landscape in India, or what is the debt capital market landscape in India. We start from the basics. Yeah.
Sure, I'll do that. And sorry, just although Vineet has mentioned it, but for the sake of abundant caution, the views I'm expressing here are my personal views. They do not represent my firm's views, and nothing that I mention on this call should be construed as a recommendation or an endorsement. So now that aside, yeah. So see, Vineet, if you see the financial asset landscape in India, okay, or maybe across the world also, why only India? So as far as retail investor participation is concerned, okay, there are two major asset classes which retail investors participate into, right? One is equity, the other is debt. Now, globally, if you see equity, we all know, and over the last 3-4 years, equity participation has increased quite a lot, both through direct equity participation as well as through mutual funds. So when you're investing in mutual fund, you are doing a SIP. Eventually, the money is going into equity markets. Debt markets, although in Western worlds, they are a lot more evolved as compared to Indian markets, where if you go to a layman, a retail investor, agar aap usko bolo ki you have to invest in debt, the default option is fixed deposit. Okay, I'll go to a bank, I'll do a fixed deposit. But the debt market opportunity and landscape is much wider than that. So, let me just give you some kind of a flavor. Who are the major participants in debt market as it stands today? If I talk about on the issuer side, so ultimately, what are bonds? Bonds are borrowings. So somebody is issuing a bond to another investor. That bond goes to that investor's demat account, and money from the investor's bank account goes to the issuer. So it is nothing but a borrowing and lending relationship. So if I talk about the issuer side, which is who are the major borrowers, the biggest bond issuer in India is the government of India. So the government securities market by far is the largest bond market. As per recent budget announcements, next year government is looking to borrow close to 15 lakh crore of gross borrowings, and then it is across tenors. They can borrow through a 6-month treasury bill, 1-year treasury bill. The most frequently quoted number is the 10-year GSEC, and then they borrow longs also, 30-year bonds, 20-year bonds, and all that. After central government, then there are state governments. So various state governments also issue bonds. They are called SDLs, state development loans. So they are the second largest borrowers. After that, we come to corporates. So corporates also issue bonds. So again, in corporates, the biggest issuers are quasi-sovereign or government-owned entities. So they will be like your PFCs, RECs, NABARD, NHB, SIDB. So these are again some of the largest borrowers in the bond market, who are also called quasi-sovereign because they are backed by the government. So once these people are out of the picture, then come the private sector bond issuers. So again, this market is heavily dominated by AAA borrowers. So if you look at the credit spectrum, it goes from all the way from AAA to D AAA, indicating highest safety, D means who's already defaulted, and there are some 18, 19 rating categories in between. So again, it is highly dominated by AAA large borrowers. So your, let's say, SDFCs, Bajaj Finance, Reliance Industries. So these are some of the larger borrowers. And then so on. So if you look, in terms of total issuance, non-AAA borrowers will be a very, very small percentage. AAA is where it constitutes the largest amount of bond issuance. On the issuer side, or people who are borrowing. How about investor side, who are actually investing into these bonds, who is buying these bonds and providing money? So again, it is, as we stand today, heavily dominated towards institutions. So who are your biggest investors? Insurance companies. So whether it is LIC or private sector insurance companies, they are one of the largest investors. Then come provident funds. Again, EPFO or private sector provident fund companies, they are biggest investors. Then so banks, as some of us would know, there is something known as an SLR, statutory liquidity ratio. Banks, as a proportion of their total balance sheet, they have to, by regulation, keep certain amounts in government securities. So banks again become by default a very large investor in this segment. And most of the banks also have a very active trading desk. So they kind of keep on investing, churning their portfolios, both in GSEC market, government securities market, as well as corporate bond market. And then you have debt mutual funds. So just like, in equity mutual funds, when you invest, your money is actually eventually going into equity markets. People are investing into stocks. Similarly, when you are investing in debt markets, whether through a liquid fund or through a short-term bond or a long-term bond portfolio, your money is going into debt market. It can be in short-term instruments like commercial paper or CDs, which are issued by banks, or it can be slightly longer-term instruments like bonds. So this is the total both side, which is issuer as well as investor side landscape as it looks like. Retail participation in Indian bond market is very, very low. And, to whatever extent it happens when some of the names which I mentioned, they come out with a public issue. To that extent, whenever investors have money, if they have money at that point in time or risk appetite at that point in time, they invest.
Got it.
After investing, so this public issue is somewhat like an IP only of shares. So equity में आप एक बार invest करने के बाद there is an active trading which happens. So I will sell, and Vineet on the other side is buying. Tomorrow Vineet will sell, Vikas will buy. So there is an active trading which happens, and the market is liquid. In corporate bonds, once I invest into these bonds, even through a public issue, the market is very shallow. There is no liquidity. So tomorrow, let's say there was a public issue from 1st of Feb to 28th of Feb. I did not have money at that point in time. The public issue is over. Now on 15th of March, I have money I want to invest. So it will be very difficult. The access is very difficult for a retail investor to actually go and see in the market which bond is trading where, kya usme return milega, kya pros, cons, cash flows kya hai. It is slightly complicated, and due to a variety of reasons, this market somehow has not developed in India. Hence, I said that if you go and speak to a retail investor ki debt karna hai, so default option comes is fixed deposit, because it is very easily accessible.
Okay. So as a follow-up to this, Rohit, I wanted to understand, maybe for the larger audience as well, is that what kind of yield ranges typically these issuers offer for the bonds that they issue? So how does it, how is the spectrum there?
Yeah. Okay. So as I said, Vineet, the market is largely dominated by AAA issuers. So when you invest in AAA issuers, the rates are very low. So today it will range anywhere between 6.5%. Then down the rating spectrum, the rates keep on rising. So let's say somebody who's rated AA plus maybe will give you 7 to 7.5%, and so on. Now there is an arbitrage which is available. I should not say arbitrage, but it is some kind of a market anomaly that higher levels of rating classification, when you go down one notch, so if you go down from AAA to AA plus, maybe the rate differential is not that high. It may increase, let's say, just by 50 basis points, which is 0.5 percentage points. But as you go down the rating spectrum, the rate differential can actually become higher. And that is where, if investors, they spend some time researching and understanding this market, they can make good returns. And the reason again is some of these companies, they don't have that ready access to bond market. Again, due to a variety of reasons. Let's say some insurance companies, they have a mandate that they cannot invest below AA plus, or they have a mandate that they have to just invest in AAA securities. Sometimes it becomes a self-fulfilling cycle, because people are investing in AAA bonds, and hence bonds have liquidity. Then only AAA issuers are, and because only AAA issuers are coming, people are investing only in AAA bonds. So it becomes kind of a self-fulfilling cycle. And so there is an opportunity that if you go slightly down the rating spectrum, yes, the risk is higher, but then if you understand it well and you take a measured approach, you invest in a quantum which is acceptable to your personal portfolio, you can make slightly higher return. So again, I kind of like the graph you show, and you have done a variety of assets, but I will make it even simpler. For a retail investor who, let's say, who's not doing crypto or who doesn't understand what venture debt is, simple options hai, 15% long term mein equity mein return aega, very good for long term wealth creation. Short term, you want protection, you want certainty, 5%. If you go to a good bank today, you will get not more than 4 to 5% in a fixed deposit. There is nothing between this 5% and 15%. So if this retail bond market actually develops, and this is a commendable effort your platform is doing, so this 7 to 12% range where people are okay to take a slightly higher risk in return for and return they will get a better return, better yield. So this 7 to 12% bracket is available, and then again there will be variety of issuers. Somebody who's, let's say, slightly better rated, who's rated AA or AA minus, may be giving 8%. Somebody who's one notch lower, maybe in the single A category, might be giving even 10%. So depending on the risk appetite of an individual investor, they can experiment, they can start small, and if the experience is good, then they can try and enlarge or invest larger amounts.
Yeah. So in matured market like US and other countries, I think the bond market itself is also very much matured, and individuals they tend to invest because they do have liquidity, they do have understanding of the product, and
So in terms of, again, if you talk about market sizes world over, the biggest market is Forex. So Forex is the biggest market. After that, actually, it is the bond market. Equity market in terms of overall size is smaller than bond market globally.
Correct. Okay. So I'll just move to the next level. Now, as you mentioned that, all these issuance by the government agencies or, PSU or quasi-government, kind of institutions, typically all the issuance is being sucked up by the insurance, LICs or mutual funds of the world. Now, where does it leave, retail people like us? How, if I want to participate, what are the avenues? How can they participate? One thing that you touched upon is, say, debt mutual fund is one of the ways that they can participate. Are there any other avenues where they can get an exposure, to these kind of products?
Yeah. So as I said, that one option is you simply invest in a debt mutual fund, who then in turn is investing into bonds indirectly. The other option is when there is a public issue. Let's say I'm not remembering in recent times if a public issue has come, but I think last year there were quite a few issues. There was REC who had done an issue, and so some of these companies, they keep on doing public issue, and during that time you can invest. Unfortunately, if you miss that window in the secondary market, it is really difficult to find liquidity, and if you want to invest, to find out कि क्या ticker है उसका, किस ticker का क्या return है, क्या price है, क्या maturity, that process is slightly not so user friendly. And so once that public issue is over, unfortunately, it is slightly difficult for retail investors to actually go and invest.
Got it. And what do you think are the issues, from a retail mindset perspective? What are the issues which bond? Is it lack of understanding of product? Is it like, what are the challenges that you think a normal retail guy has today in India as far as investing in bond market is concerned?
No, so I will first touch upon, there are two key risks which any investor should understand. And once they are kind of imbibing that these are the risks I'm okay with, okay, so let me just first talk about the risk, and then maybe how should one think about when they are going to invest in such products. So see, the two major risks are credit risk or default risk, and the second risk is liquidity risk. Okay, so what is credit risk? As I said, if you go and invest in an FD, up to 5 lakhs, it is actually insured by government agencies. But even though let's say, even if it is not insured, in commercial banks, no one has ever lost money in India. There might be smaller cooperative banks, etc., who are non-scheduled banks. There something would have happened. I'm not too sure what are the pros and cons of investing there. But in commercial banks, scheduled banks, the risk of losing money is very less.
Yeah.
As if you are investing into some of these people that I just spoke about, if you're going down the rating spectrum, let's say if you're going to an entity who's rated single A, whose rating is triple B category, although there is a historical default study which all the rating agencies do. So if you go to CRISIL's website, ICRA's website, they will show you a default study, like let's say a single A rated issuer also over a 3-year period, the risk of default is only like 1.5 to 2%. Okay. But having said that, the risk of default is different versus investing in an FD where you have, fill it, shut it, forget it. There is nothing to worry about. There is a risk of default. So that is the first thing, any investor should know. Obviously, if a default happens, there is legal recourse available, and there will be, let's say, a bankruptcy filing will happen, proceedings will happen. Although it might take some time, there will be some recovery also. But the first place, one should be comfortable with the fact that there is a default which can happen. The second is illiquidity risk. Now, what is that? So as I mentioned, there is no secondary market liquidity available in India. So once you have invested, if let's say you have invested in a 2-year bond, after 3 months, there is a requirement of some money, you want to exit this investment. There is, so in theory, it is tradable because it is an instrument which is sitting in your demat account, just like shares, they are sitting in your demat account. So theoretically, you can trade in that. But typically, as of today, for retail investors, bond market is not that developed. So if you want to exit this investment after 3 months, it is very much possible and probable exit, or at least exit at favorable terms. So these are 2 key risks any investor should understand before they are looking to invest. Now these risks are there. Why should one take this risk, and what should be the approach? So as I said, that the returns are different if you are taking a different risk. So in a large bank fixed deposit, you are getting 5%. And if you're investing in a bond, you can get as high as 9, 10, 11, 12%. And as I said, over a long-term equity market is also expected to give you 15% only with all its volatility. So somebody who doesn't like volatility and who wants to be assured of what is going to be the return, this is a product which lies between fixed deposit and equity market. So you are taking slightly lower risk versus equity market, slightly higher risk versus FDs, and the returns are also lower versus equity and higher versus fixed deposits. So this is one thing, that yes, the risk is higher, and that is why the return is also higher. So you should be comfortable with the fact that if you are investing in 10 names, there is a probability that something bad can happen in one name. So you should be comfortable with the fact that you are taking a higher risk. So this, in terms of liquidity risk, how should one manage? See, always in your portfolio, there will be one portion of money which is not required immediately or not required at all. It will always be invested. Now, whatever you mentioned, the alternate investments where retail investors should invest with 10 to 20%. I do not know what that number is because it will differ from person to person.
Correct.
One person, it can be 10%.
Yeah, that's basis a general global study.
No, I'm just saying at a personal level, when a person is deciding individually.
Yeah.
So, जो portion of investment you feel you can lock in for the period of investment, चाहे वो 1 साल है, 2 साल है, only that portion should be invested into bonds. So ऐसा नहीं है कि आपका 1 लाख का portfolio है, you should invest 50,000. You should not do that. If you feel that out of this 1 lakh portfolio, there is 10,000 or 20,000, which I can afford to lock in for 2 years because 80,000 is available to me, कि कुछ emergency होगा, that liquidity is available. So that you keep that 80,000 aside, this 20% which you can lock in. Important thing is whatever is your emergency fund. So again, there are some rules. Somebody keeps 1 month's salary as emergency. Somebody will keep 3 months salary. That you do not invest. Only the portion which you think you can lock in, that money should be invested in bond markets.
Correct. Also, one thing that we have seen typically in bond markets is the tenor. So typically all these issuance by government or be it from quasi-government companies, that generally the tenor are very long. It's like 5-year plus generally.
Yes.
So
Yeah.
we feel sometimes that, that is something which is not right, maybe from a retail investor point of view.
Yeah,
What
yeah.
is your thought on that? I mean,
No. So this is exactly what I was saying when I was mentioning the liquidity risk part of it. That जितना ज़्यादा आप lock-in period बढ़ाओगे, if you increase the lock-in period, the proportion of my portfolio that I can invest will keep going down. So again, as an example, if you tell me that there is a 1-year lock-in, maybe 20%, 25% of my portfolio I can invest. If you say there is a 2-year lock-in, maybe 10% of my portfolio I can invest. But if you say there is a 5-year lock-in, I will invest only, let's say 5%. If you say there is a 10-year lock-in, I might not invest at all. Or if even if I invest, I will invest, let's say, only a 1% of my portfolio. So the tenor point is linked to the liquidity risk for how long you can afford to lock in your investments.
got it. And okay.
So I'll ask in the meantime. So some of the questions that Rohit have been going up, so I'll take one of those for you. So Mr. Sanjeev Joshi has asked, from investment point of view, one thing that always bothers me is the visibility into the data of the defaulters in corporate bonds. So he wants to know where can one find access the data on the corporate bonds and the defaulters. Is there any ready database available for retail investors to access to?
Access data of people who have already defaulted, you mean?
Yes, the corporate bonds which have gone bust.
I cannot readily think of. I'm sure there would be some database, but I cannot readily think. I can search and come back to you, Vikas, and maybe you can share with Mr. Joshi later on.
And just to Rohit,
because see, in terms of insolvency filings, that you can get out of NCLT, people who are filing for insolvency. So that data is now readily available under IBC, people, whoever is initiating a proceeding. But per se, entities who have defaulted and are under proceedings, I'm not sure if there is a database for that.
Okay. Yeah, Vineet, you were saying something.
No, I think.
Okay. So, Rohit, so we have heard about the credit risk and the liquidity risk. You have explained it fairly well. So, how does a retail participant evaluate a deal, whether he should go, because his knowledge base and the capability and the time available with him may not be that great. So, what are the few pointers that you would like investor to evaluate before looking at a deal? What would be few hacks that you would like to give to them?
See, as I said that, and very rightly, because people who are financial market participants, maybe they will have advantage of slightly higher knowledge, but most of our investor friends may not be from financial markets. Somebody would be a doctor, lawyer, engineer. So their core expertise lies somewhere else. So see, my only submission here will be, it is a newer asset class. It is worthwhile to spend some time and understand about a company before you are investing. And even when you are doing, take small steps. Okay, there is no requirement, suddenly somebody is flashing, I will give you 15% return. And I say, oh, wow, I have a 1 lakh rupees portfolio. Let me put 50,000 there. There is no requirement to do that. It is a new product. Life is long. You can, there will always be opportunities which will come around. Take small steps, feel comfortable. Take time, let some money come back, let some interest come back, let some of your assets mature. And after that, as you gain confidence, you go up. There is no easy way out to it. One is obviously, platforms like yours, they are doing a good job in trying to educate investors. So again, there's no shortcut. One should not assume that just because an asset is, flashed on a platform, I should just go and invest. You have to go through the balance sheet. You have to go through the P&L. And there are some basic stuff, let's say a debt to equity ratio. What is a debt to equity ratio? Why a higher debt to equity ratio is worse? Why should lower debt to equity should be considered favorably? What is the rating? Read the rating rationale. Rating agencies do a good job. They, give a crisp summary. What are the key risks and strengths and weaknesses of a company? So these are some of the, kind of low hanging fruits in the knowledge tree one should grab before they want to start investing. Till the time you get confidence, you should not. It is somewhat, like investing in stocks also, isn't it? That when you are first entering into the stock market, you will not invest whatever money you have. You will try and feel your way around. You will do some research. You will see which stock has done well historically. Bonds, since it is kind of a newer asset class for retail investors, there's not too much historical information available. And hence it is important that you do your research, you try and understand, you get as much education as possible, and still you take baby steps. And over a period, as you, get more confidence, then you can maybe deploy a larger part of your personal portfolio.
There are some good points you mentioned here, Rohit. In fact, as a platform, that's what we even try and educate our investors, that we help them understand this product better. The first thing that we want to do is that that they should understand what it is. Obviously, we are trying to match the gap in understanding. Okay, because there is someone issuing and there is someone subscribing. There is a knowledge gap, right? And that is what we are trying to simplify those things and explain them in a simple manner.
And Vineet, that is a very good point you mentioned. See, if you compare with equity markets of 20 years ago, okay, there wasn't such a developed equity research setup. There were very few research analysts. The research reports also, the access was available again only to large institutions. So I think possibly that is where bond market is today. That there is some research, but it is restricted as of now only to institutions. So as and when the market develops, there will be more participants, more platforms, more issuers, and the quality of research, etc., will keep on improving. So it is most important that any investor who's investing should not feel any compulsion or a fear that I should invest now, otherwise the opportunity will go away. Please be comfortable. There will always be opportunities. इस महीने ने किया, अगले महीने आ जाएगा, अगले quarter आ जाएगा. Don't feel any compulsion to invest till the time you feel yourself, you are comfortable in your skin that, okay, this is an investment where I can, deploy 2%, 5%, 10% of my portfolio.
Correct. So even we have the same philosophy, Rohit. Like you mentioned, equity, same story was with mutual fund as an industry. It started in 2005, 2008. Very few people started investing, but today somebody earning 20,000 rupees is also doing a 500 rupees SIP.
Yes.
So we believe that this industry is also going through that cycle, and in next couple of years, again, it will become a mainstream product. Everybody will start understanding, but it is not very complex. It is just that it is new. That's all.
No. As I said, the return behavior is absolutely same as fixed deposit, which is the most common product. So, if you see total India mein fixed deposit market, my sense it is somewhere close to 150 lakh crore. That is the amount of fixed deposit which is sitting in banking system. Obviously, some part of it is of corporates also. Corporates also keep fixed deposit, and retail investors also keep fixed deposit. But that is the size of the market. So return behavior is exactly same hai. There is a periodic return you get. Maturity हो जाएगा तो आपको आपके जो भी प्रिंसिपल है वो मिल जाएगा. Just that the different risk involved, वो आपको समझना है. If you are comfortable, you invest. If you're not comfortable, you don't invest.
Correct. So yeah, even we believe that in couple of years, most of the people will start understanding this. It will become a mainstream product. The people who understand it earlier will ride the wave for a longer time. That's all.
Yes, absolutely.
Great. Okay, one last question from my end is that, say in this current volatile market, right? For last couple of months, the market has become volatile. There is a, rising interest rate kind of a scenario right now. So now in this kind of a market, if somebody has to choose a product in this space, in the bond space, what they should look at? They should look at a longer tenor, they should look at shorter tenor, repayment frequency. What would be the 2-3 basic parameters that they should look at?
So Vineet, again, I think there is no one answer to it. I think the answer is diversification. So you don't put all your money in one asset. Whatever you are looking to invest, if you have a 1 lakh rupee portfolio, you felt comfortable, okay, I can put 20,000 in bonds. Don't put entire 20,000 in one bond. Experiment. Invest in 3 bonds, invest in 4 bonds, 5,000 ke 4 bond mein invest kijiye, wherever there is a possibility, if the ticket sizes are lower. If it is higher, then you wait till the time, you have that kind of a portfolio size. Because, again, multiple options, somebody, so jo credit risk, we spoke about credit risk, right? That there is a default possibility. Now there are ways to mitigate. Same issuer, if you are investing for 3 months versus 3 years, your risk is significantly lower because your visibility of that issuer, that company going bust in 3 months is much higher. Company is doing well unless there is some fraud, etc. happening, which I don't know how to, kind of predict. company is doing well, the possibility that in 3 months, 6 months time it will go bust is lower, versus if you're investing for 3 years, it is higher. If you're investing for 10 years, it's even higher.
Correct.
So, you kind of diversify your portfolio, experiment with different assets, try and match with your cash flow requirements. Again, just a very simple example. Let's say somebody's kid is in class 10, right? And after 2 years, he or she will pass out of class 12, and then they will go for professional studies. Somebody will go for medical engineering or wherever their interests lie. You know that after 2 years, I will require some money. So even if you're investing in bonds or fixed deposits, do not invest for something which is maturing in 3 years or 5 years. You know there is a requirement of money at the end of 2 years. So invest for something which is maturing in 18 months or 24 months. So at your personal level also, you do this balance sheet management that I will have a requirement at the end of 2 years. Let's say you are planning to buy a car. Okay. And you know that the car you want to buy, you can only save money in 2 years. You don't have money immediately. So you invest in something which will mature in 2 years. That money will come back to you, and you can do whatever you are looking to do, buy a car, send your child to a higher education.
Got it. There are a couple of questions from our attendees, but I will take those questions in our Q&A session.
Sure.
I think we can move to the home credit presentation now, and then
okay. So I'll stop my video for that.
Yeah, so Rohit, we'll give you time to read through the questions and prepare your answers. So there are a lot of queries that are coming your way. People want to listen to you. So I'll take some airtime out here, and we'll just introduce our opportunity, which is live on our platform. So I'll be sharing my screen now. Vineet, is my screen available?
Yeah, it is visible.
Yeah. Hi, everyone. Good morning, and thanks for joining it. So the opportunity that we are unveiling here is a NCD of a leading NBFC, which is into consumer lending space. It goes by the name of Home Credit. So first, I'll inform the deal structure. So the minimum ticket size in which a investor can participate is rupees 1 lakh. The deal is offering the IRR of 12%. It is a 15-month opportunity. The corporate is rated triple B plus by CRISIL and India Ratings, which is part of Fitch Group. The duration of the NCD is 15 months, and it is a quarterly amortizing structure which means like the principal and interest will be paid once in quarter. So I'll elaborate on the repayment structure later. So what is it, this home credit? So to give a bird's eye view, home credit is part of a PPF group, which is based out of Netherlands, and it is a big conglomerate, and it has it has invested into different sectors, and it's into mechanical engineering, real estate, media, telecommunication, financial services, and others. It's present in 25 countries across the world. The total assets under this group is 40 billion euros, and they hold around 6.5 billion cash on its balance sheet. That roughly translates to 53,000 crores, and their employee strength world over is 82,000, and they have been profitable, and in last 6 years they have given net profit of 4 billion euros. Their entire financial services business is housed under the Home Credit brand name, which is present in 9 countries, and they do the same business in Vietnam, Indonesia, China, Russia, Philippines, all these emerging markets. And the overview of India operations is as such. On the right hand side, you can see the company had around, as on March 21st, 2021, they had an asset base of around 6,000 crores. It's currently present in 625 plus cities. They have already catered to 1.4 crore customers. They have 53,000 partnerships, and the parent has already given them around 4,700 crore of equity and debt support. And external borrowing is in, as on March 2021, 1,000 crore, which has further reduced around 750 crores. The gross and net NPA numbers are there to see. It's very low at 0.35%. The capital adequacy ratio, which is roughly equity to total assets, is around 21%. So that's a financial snapshot of the Home Credit India on your right side. So what is this company does? So this company came into India in 2012, and it has been in India for last 8 years, and it has been doing great. So their main business is in only into two products: consumer durable loans and personal loans. So they give. So if you go to any nearby, say, mobile shop, and a person wants to buy a mobile phone, so what they will do, they will ask for some upfront payment from the buyer, and the rest of the funding is done by Home Credit. So they have their proprietary algorithm, which through which they assess the credit risk of the buyer, and the it has been tuned for last 20 years across the geographies. So that's the strength they have. The parent has seen this cycle in similar countries like India, the emerging countries like Philippines, Vietnam, where they have been able to prove their model. And so these consumer durable loans are for a small tenor, and the average loan size is 10,000, and it lasts for 7 months. And the basis, the history of consumer durable loans, the company gives the personal loan to basis the credit history with the Home Credit, and it's sort of cross-sell product for the good behavior and the repeat borrowers. So these are the two main products which Home Credit is in. It has also tied up with DBS Bank for co-lending. And uh, so I'll come. Why are we bringing this opportunity? Why is Giraffe offering this? What do we find? Why do we find it lucrative? So one of the key reason is that Home Credit is part of a very large group which is present in 9 countries. Home Credit, it has a strong parent which has shown its willingness to support it over last 8 years. They have already infused fairly good amount of money. I think to around 4,000 crores they have already infused in the business. They have a huge liquidity, cash sitting on their balance sheet. It is triple B plus rated by CRISIL and India rating. So that's a validation of their business model. The tenor is small, 15 months. And as Rohit explained earlier, the tenor is a very important criteria that an retail investor should look at. The money, so you keep getting, say, if you invest 10 lakh, so every 3 months, the investor would get 2,17,000 directly into their demat account. The company pays directly to the account which is linked to the demat. The we have seen that as of now, the product which Home Credit is offering is something similar to BNPL. So that's there's a new name for buy now, pay later. So they have many companies that have come up in this space, but Home Credit has a play both in offline and online segment. So this is a unique business model. The parent, if you see at the management, there is a CEO, which is Mr. Andre Kubik. So there is a total support and oversight of the parent on the India operations. The company has a very high NIM of 30%. They have been profitable as on in last quarter of December. And we find that it's a sweet spot, that it's a large opportunity. If you were to source this, invest in this company, you will have to shell out something north of 1 crore to participate in these bonds. So uh, we are bringing it by dissecting the size to a smaller investment size of rupees 1 lakh. And Giraffe is offering you a very seamless experience to invest, and the bonds get directly credited to your demat account, and you get the returns directly from the company. And uh, So I'll come on to the transactional side. So what is the repayment schedule? The minimum investment that an investor can do is rupees 1 lakh, as I told earlier. The total issue amount is 10 crores. The credit rating of the borrower is CRISIL triple B plus and India ratings. The tenor is a 15-month. It is a senior secured bond. That means the security is 1x charge on the receivables. The principal and both accrued interest are secured by the receivables. The instrument is NCD. which is listed on both the exchanges, NSE and BSE, but it is not tradable. It's not publicly tradable. The repayment is in 5 equal quarterly installment. The rate of return or the coupon is 11.5% per annum per quarter. The IRR is 12%. We have some safeguard mandatory redemption events as are there in most of the bonds. Risks on this bond is the segment to which home credit is lending is susceptible to economic downturn. So the events like COVID-19 can stress the portfolio, but however, we have seen the parents' capability to infuse the equity and support it over a period of time. And mitigants, there's a strong capitalization, there's a huge liquidity sitting at their balance sheet, they have a big network in India, the market is growing, the BNPL market is growing, and the company is growing on a yearly basis. So these are the mitigants. How does one invest into this opportunity? So one can go to our website, it is www.giraffe.com. So the spelling of Giraffe is JIRAAF.com. You need to sign up and register through your mobile number. You will get an OTP. You confirm your email ID, upload your ID, which is PAN or an address proof. The KYC will get approved. And once the KYC is approved, you can click on the opportunities. You can look at the FAQ sections for further clarification. There are documents. There's a pre-placement offer letter, which is a 45-page document, which gives the financial overview, the company's financials and the key risk as highlighted by the company. You can go through that and understand it better. If you have any queries, you can get back to us. You can give us a call, or you can write us on support@giraffe.com. Once you are satisfied with the opportunity, you can invest, you can choose the number of units, and then you will have to sign a security transfer form and give your demat account number, and you can make the payment through the payment gateway, and you can track this investment through our dashboard once the same is made. This will also be visible in your demat account once we transfer the bonds, which takes around a couple of days. So who we are is already covered by Vineet in the starting section, so I'll just skip it.
Yeah. Thank you, Vikas, for the presentation. So now, since we are running out of time, the way we will structure this is that, I'll ask a couple of questions, but for the questions that we cannot answer because we have a hard stop at, around 12:30, maybe we can stretch it up to 5 minutes, 12:35. And then we will try and answer those questions via email to everyone. But there are 3 sets of questions. One couple of questions for Rohit, which is in general for the bond markets. There are a couple of questions, Vikas, for the deal that I'll ask you. And then there are a few questions for the platform as Giraffe. So Rohit, one of the questions was, should a retail investor only look at third-party rating, which is given by agencies, as criteria for investment? I think, Vikas, once Rohit has spoken, you can also give your view on the same question.
Yeah, I'll take this one very quickly. See, rating agencies give their opinion, and obviously they are certified and professional, so they are giving their opinion on the rating of the company. But it always makes sense that investors kind of understand the risks which are underlying in any asset, and once they are comfortable, so they should assume rating is just one input, and then they should understand the portfolio. I just want to make one more point here. See the equation of expected loss very quickly. EL is equal to PD, which is probability of default, into LGD, which is loss given default. So your expected loss is equal to what is the probability of a company defaulting, and if the company is defaulting, what will be your loss. So very quickly, let's say if I take an example that you are investing in a company which is a very small company, typically it will get a very low rating. Okay, but if it is 100% secured, or let's say 110% secured by cash, which is kept with you only, so your probability of default is higher. It is a small company, economic downturn can hit, COVID can happen, the company might shut down. But what is your loss given default? It is 0, because there is 100% security of cash, which is with you only. So when you are investing in any asset, you have to consider probability of default, which is reflected in some sense by ratings also, However, having said that, you should do your own research. You should understand the risk, and you should also assess what is the security available. So this is, I think, my view on this.
Any take, Vikas, on
Yeah, I
this?
agree. So, credit rating agencies are the certified agency, and they do their job fairly decent. So, the assessment of credit rating is just a guiding line. So, an investor should go through the documents and ask the questions if there's any doubt. They should try to understand the opportunity in a better manner, and they should start small, and they should invest in opportunities which has a regular cash flows. Once they build up a comfort and a track record, then they should go it large. So that's even with any financial product that one prices. So one should not put all their eggs in the same bucket. So they should diversify in all the opportunities so that the risk mitigates.
We have one question from Mr. Prempal Singh. His broad question here, Rohit, is for you: is as an individual investor, is it would you recommend that investment should be done via credit risk fund rather than investing in a single deal?
Okay. See, and it's a very good question. I have some kind of a background to this because I personally was a credit risk fund manager some many 8 years ago. Sir, my take on this is, if you are investing through a credit risk fund, your risk is getting diversified because the underlying portfolio is getting invested over a variety of products, a variety of investments. But what happens is, since credit risk funds are generally open-ended funds, and there is a requirement of maintaining a minimum level of liquidity. Let's say 25% of the portfolio will be invested in very liquid assets, whose return also will be much lower, because there is on a daily basis investors are coming in, going out. The returns also get diluted to that extent. So that is one. Second is, there is an interest risk component also. So as many of us would be aware, price bonds are inversely correlated to interest rates. So if interest rates go up, prices come down. So there is an MTM impact which happens in portfolios. So when you are investing in a credit risk fund, generally you can't be certain that if you're investing for 1 year, what is the return you will get out after 1 year. Definitely it will be on an average higher than other short-term bond funds which is investing only in AAA. But if you are investing today and expecting ki 1 saal ke baad I will get 8%, definitely that will not happen. The returns will be higher than short-term bond funds which will be rated AAA, or they are investing in assets which are rated AAA, but you cannot be certain. So if you're looking for certainty, so first is, when you're investing in an NCD, you know what is the return you are going to get after 1 year. Second is, here you are assessing the risk yourself. So, and hence you kind of know where the money is going. And third is, you are investing only that part of the portfolio where you can afford to, take a higher risk. So in these 2-3 ways, investment in bonds is different from investing in credit risk funds.
Yeah, to add that credit risk fund is a sort of blind pool. You do not know where your money is being put into. So here at least investors have a choice to evaluate themselves and take a conscious decision whether they like the structure as per their cash flows, when will they get money. So all those things become easier for him.
A couple of questions for you, Vikas. Is the NCD rated
Sorry,
by
just
any...
one.
Yeah,
Sorry,
sure, sure.
just one more point on the earlier point. So, and when you are evaluating, credit risk fund versus an NCD, you should look at historical returns also. What are the returns credit risk funds have delivered? So I don't have the data readily available with me, but investors can do a quick check. You can do a Google search, you can get it. If the returns are in the 7 to 8% bucket, and if you're getting, let's say, a 10% return in an NCD, so to that extent, that there is a possibility of you making 2% higher return if you are willing to take that extra risk, and you are willing to spend time to get that knowledge, get that education. So I think the returns slightly better in bonds. Having said that, there is a liquidity risk also you take. You are locking in your money for a long time.
Correct. So a couple of quick questions, Vikas, on the home credit deal. Is the NCD rated by any agency? It was
Yes,
one of the questions.
it is rated BBB plus by India Ratings, which is part of the Fitch Group.
Okay. And how do we check, in case of any possibility of fraud in the system? This was asked with Mr. Dinesh Ajwani. And is there any kind of, a background of the promoter or DD that we do on there?
Yes, so that's we have a fairly robust credit system, and if you see my second slide, we were giving the overview of home credit group. So it is present in 9 countries under the same brand, the PPF group. So we have done all their due diligence. We have looked at their balance sheet across the different countries. So the most important part is the intention to pay. Then there's a second part which is ability to pay. So ability to pay is like reflected in triple B plus, but the intention to pay is comes from the promoter. So we take extra caution. It's a MNC group which has been there. What is its track record? It's not that someone who has started business in say five years back or 2 years back. The company has been into this business, same business across 9 countries in for over more than 20 years. It started in 1997. So we have a fairly good track record of this company. And yes, so the promoter itself is Home Credit NV, which in turn is owned by PPF Group. So this is also available on their website, and the gentleman can search on its own.
Okay. There is one more question. It's a similar question by a couple of people, so I'm just merging the question. What are the steps basically which Giraffe takes for listing any deal, because they have seen a couple of regulated or secured entities like DHFL, etc., going bust where people have lost money.
Yeah, so Vineet, as I told you in my previous question, there are two parts of credit risk. One is ability to pay, one is intention to pay. So ability to pay can be gauged by the financials, and that's all the due diligence we do. But when you say intention, so in those companies, it was very difficult. Even the regulators and the credit rating agency were unable to gauge it. So that's the risk which remains in each and every deal. From our side, we try to bring those deals only where we know the promoter is has there's a high level of corporate governance. So we try to minimize this risk. Having said that, this risk always remains. Even the banks and the mutual funds and the credit rating agencies who have the wherewithal and slightly more power to evaluate the deals, even they have burned their fingers, because fraud is something you cannot predict. So that's the limitation of this. And to mitigate this risk, one should try to diversify in as much opportunities as possible.
Yeah, I
And
think it brings down to the same point with Rohit mentioned earlier, that
correct.
diversification across products is necessary, and you should not, like invest 50% of your investable corpus, say,
Yeah.
in one
Another
deal.
thing, the people invested in Yes Bank 81 bond. So it's a perpetual bond. So even the tenor should be kept in mind while you're investing. So you are a retail investor. You should not purely go for the return itself. The tenor itself reduces the risk to a very large extent. That one should keep in mind. And to answer your second question, what type of due diligence we do? So we talk to the promoter. We have a discussion with the finance team. We bring this. We took all the financials. We go through them. We prepare a credit note. We present it to our credit committee. There is a 5-6 member committee that we have, internal committee, who have a combined experience of more than 70 years. We deliberate on each and every part of the deal. What are the risks? Whether it's worth writing. So there's an entire due diligence which goes before deciding a deal, and it takes almost 2 to 3 months groundwork to curate a deal and then list it on our platform.
We'll just take last couple of questions as we are running out of time. What does it mean when we say, we have 1x charge on receivables as security?
So Rohit, you want to take that for NBFC?
I'll take this quickly. No, I'll take this quickly. Actually, I don't know if I can. Okay, since there is shortage of time, I'll not give a long explanation. So basically, if you look at any NBFC, okay, so if you go to a manufacturing company, uske asset sides mein what will be there? There will be plant and machinery, and there will be current assets. Okay, and if you are giving a loan, those plant and machinery or current assets, stock, etc., will be given to you as security. NBFC ke balance sheet mein on the asset side are the loans which it has given to other people. So for example, any retail, let's say if you go to HDFC Limited, on the asset side, it will be home loans it is given to various people. So when that NBFC is borrowing, The loan, it is in turn given to various borrowers, where various retail borrowers is your security, which means, let's say if you remove that layer of that NBFC being in between, you have a charge against those borrowers. Those borrowers will repay the money, and that money will come back to you. Having said that, since it is on balance sheet, you have that extra protection of the existing capital, etc., of an NBFC. So this is in nutshell what happens. The asset of an NBFC is the loan which it is given to various retail borrowers. That in turn becomes a security for our money when we are investing.
One question for you, Vikas. In case of a default or an NPA, what rights do we have, and what steps Giraffe as a platform will take on behalf of the investors?
Yeah, so I'll talk about this particular deal, which is a home credit NCD. In this structure, for any NCD structure, there is a debenture trustee who is catalyst in this case. If any default happens, it will take the legal actions which are available under the law, which is IBC, and it will safeguard their interest. Since these are secured, they get priority over the unsecured and the operational creditors. And you are at par with any other lender on the balance sheet of home credit, and whatever the legal recovery happens, it will be done and distributed amongst the investors. So there's a third party debenture trustee by the name of Catalyst who is safeguarding the interests of the debenture holders.
Got it. We have one question for Mr. Rohit. Is that would you recommend or would you invest in the home credit deal yourself?
Oh, sorry,
So that's something I think he clarified.
Yeah.
So I think as this I mentioned in the starting itself, that there is no endorsement from my side nor my firm on this deal. So investors should do their own due diligence before they want to invest in the.
Correct. So I think we are done with our Q&A. There are a couple of questions. I think we will, as a platform, we will send those answers to you because we have already shot past 10 minutes from our hard stop time. Thank you everyone for attending this session. If you have any other doubts, please feel free to reach out to us. You can email us, you can call us, and we will have our team addressing those queries to you. For whatever queries we have not answered, you will get a response from our team over email. Thank you again for joining. Thank you, Rohit, for the session.
It was very nice for having me.
We learned a lot from you, sir. Rohit, look forward.
Nice to be of help. Thank you.
Thanks.